The recent update to the Ethereum protocol has postponed the looming difficulty bomb indefinitely. While Ethereum's proof-of-work chain will continue to generate blocks, a new implementation called Proof of Stake will significantly increase mining difficulty. The goal of the difficulty bomb is to encourage miners to migrate to the new Proof of Stake chain. In addition, the difficulty bomb that was expected to explode in June is actually a temporary measure designed to force miners to upgrade their software. Ethereum developers have been delaying the bomb since the test merge on the Robson network went largely well. This delay is expected to help the network when the real merge occurs in December. That change is expected to shift Ethereum's network from proof of work to proof of stake. If the merge occurs, the resulting difficulty bomb will drive up the cost of mining. The aim of the difficulty bomb is to remove the incentive for miners to mine Ethereum and encourage staking. With the help of the new mining algorithm, this difficulty bomb will smother all other altcoins. And that's just the beginning. The merge will also increase the regulatory moat of Ethereum and the beacon chain proof-of-stake consensus system. The merge will result in a 99% more efficient method of generating new Ethereum. Moreover, proof-of-stake will improve the accessibility, security, and scalability of the system. After the merge, ETH will have a higher staking difficulty than before. Miners who want to continue mining Ethereum may want to look for alternative coins to mine. Other proof-of-work cryptocurrencies will likely survive the merger, but it will be difficult to sustain a profitable mining activity. The recent ban on cryptocurrency mining in China caused a significant dip in difficulty. This shows how rapidly mining difficulty can change over time. Mining Ethereum will become difficult unless there is a significant shift in its popularity. The Ethereum merge is expected to take place sometime in the first half of 2022, and the time frame between July 6, 2022 and September 2022 is still unknown. A successful merge will lay a decentralized and secure foundation for Ethereum. Whether or not the merge occurs will have profound effects on the industry. If the merge occurs, mining Ethereum could become nearly unprofitable. However, even then, it is possible to earn a profit from mining a single GPU. The merge will bring about sweeping changes to the infrastructure of the Ethereum network, affecting every part of the ecosystem. The merge will also introduce new incentives for mining, which will directly affect the way users are rewarded for their efforts. In addition, the merge will impact the finality of blocks and MEV-related transaction risks. However, the merge will not change the cost of gas, as many hope. The Ethereum merge will take place when the terminal total difficulty (TTD) for the network reaches a certain threshold, triggering the transition from proof-of-work to proof-of-stake mining. As the merge nears, the term Eth2 will become deprecated. The merge will result in one Ethereum network. This will eliminate the need for both Eth1 and Eth2 mining fees. In addition, the merger will eliminate the ETH token rewards for validators, a key mechanism for mining. Under POS, validators will receive a block reward rather than a network subsidy. However, this new mining fee structure may lead to deflationary conditions during periods of high demand for block space. These changes are likely to have a profound effect on the price of ETH. The London hard fork, which took place in August 2021, was a preparation for the merge. The London hard fork used a formula to determine the cost of each transaction, the number of gas units, limit, plus the price per unit. In an example, this would have been 21,000 units of gas and the price per unit was 200 GWI. Thus, the gas fee would be 4,200,000 GWI, or 0.0042 ETH. Besides a more efficient way of mining ETH, the merge will also eliminate the negative ESG narrative which prevents institutional investors from investing in crypto assets. The transition from a proof-of-work consensus to a proof-of-stake protocol will make ETH a more attractive passive asset. Further, this merger will significantly improve the profitability of ETH mining. The merge will make Ethereum mining more sustainable and will lead to increased institutional interest. While the cryptocurrency market is saturated with coins, many are hesitant to switch over. Ethereum has decided to transition to a new proof-of-stake model, which requires the users to stake existing Ether. The new model uses less power than mining, which should translate into faster transactions. Unfortunately, Ethereum's transition to proof-of-stake has been repeatedly delayed due to implementation flaws. While the transition to POS is expected to take place in the next year or so, there are some concerns. For one, Ethereum's transition is a major upgrade that will affect the entire ecosystem. It will significantly reduce the transaction time and fees, as well as require less computing power. Ultimately, Ethereum will be a more secure and user-friendly digital currency. A recent survey by a cryptocurrency news website indicates that the switch to POS will have several benefits for the cryptocurrency's users. Another key change is that gas fees are now being adjusted to reflect Ethereum 2.0. Although the transition from proof-of-work to proof-of-stake will take some time, the overall change to proof-of-stake is anticipated to take place this summer. The new system promises to be faster, more secure, and lower in supply than proof-of-work. In the long run, this should boost Ether's price. The change from proof-of-work to proof-of-stake is a significant one for the cryptocurrency. The network has grown significantly, but the legacy POW consensus mechanism has resulted in high transaction costs. Fortunately, the transition to proof-of-stake should reduce these costs, especially for the dApps. And it's all a good thing for the ecosystem. While many people hoped for a quick switch, some are not so sure. For one thing, there's a large number of people who still mine the original chain. These are people who've lost a lot of money by investing in the original chain. And some people may not want to wait another year for their cryptocurrency to double. Ultimately, the success of competing cryptocurrencies is dependent on how their coin will fare in open markets. In the first half of 2018, cryptocurrency miners made $4.7 billion in profit, down from $6.9 billion in the second half. However, the ever-growing competition between big mining pools and the increasing difficulty of the Bitcoin algorithm are making it harder for new players to get their first cryptocurrency. As a result, the prices have plunged more than 38% in 2 months. This decline in price coincides with the holiday season, when cryptocurrency markets are traditionally slower. A few months ago, the cryptocurrency industry was making 50% gross profits, a margin that has since been cut by a quarter. However, the price of Ethereum has fallen by a third since the beginning of the year, and miners' total revenue has decreased by a fifth. This means that GPU miners will find it increasingly difficult to turn a profit, and the price of Ethereum has fallen to its lowest point since January 1, 2021. In addition to the decline in the price of ETH, soaring energy costs are also weighing on the profitability of miners. Mining profits have fallen significantly since June as a result of the steep fall in the price of the digital asset. Meanwhile, the price of Bitcoin is expected to double within 4 years. The decline in block subsidy means that miners will be less profitable in the short term, but they will gain more in the long term. In November, the cryptocurrency market looked to have been immune to the global recession and tech sell-off. However, recent price action has put that to rest. The price of ETH is down 65% from its November high, $1,700. Moreover, mining fees have also increased dramatically. Therefore, many investors have been forced to sell their cryptocurrency holdings as a hedge against falling prices. But as of now, the crypto market is bouncing back. 4,000 by the end of the year. This decline will continue into 2026. That is why investors have begun betting on the cryptocurrency in the long run. So, how can Ethereum mining profitably compete with cryptocurrencies? With the right strategy, it will make a miner's profitability soar.